Hello, everybody, and welcome back to my show. I hope you're well. Let's talk some news. But there's so much of it out there, I don't know what to say first. Should we talk about Piers Morgan and the investigation that Meghan Markle has put into the works, or the fact that she wants to run for presidency, or the Bachelorette show, where that poor woman was cornered by two men and she was guilt shamed for being whatever she is and crying? If I were her, I would have left that place. It's been like, I got my celebrity status, I'm out of here, people. But you know what? Let's not talk about this. There's bigger fish to fry. We have our economy's on the brinks of collapse, so we need to focus on that, prep ourselves, and be ahead of the curve, people. So let's get to the news. Zero Hedge headline: Feds disappoint market, let SLR relief expire. What happens next? SLR relief expiring could cause concerns for folks like you and I, or maybe not so. Zero Hedge reported that SKYRM said, quote, since large banks are the largest cash providers in the repo market, less cash is intermediated into the market and repo rates rise. Volatility increases as repo assets move from the longest banks to other repo participants. Term repos will rise or will be higher. Now, if you recall, in March 4th, as CNBC headlined monthly auto loans payments surged to record highs as borrowing hits biggest one-year jump, Experian says. The average monthly payment for a new car is $600. Those who took out loans for a new car borrowed on average around $35,000. Almost a jump from almost a 2,000 borrowed a year before. While borrowing for a used car loan surged, where the average person borrowed around $25,000, up almost $1,700 from the year before. What are the ramifications of the SLR relief expiring? What other ramifications besides repos in people's alleys? You know what I mean? I don't want people losing their cars, but this is going to be a sad situation of people getting these luxury cars or any cars and not having the money to pay for them, and Mr. Repo is going to be down the street collecting their cars, and that's going to be a sad situation. I hope that's not going to be a big one. So yesterday, financial strategists pointed out to us that with this rapid inflation, QE, quantitative easing, and bank reserves in excess, this will allow banks to not have the desirability nor the ability to lend to people like you and I. Yeah, not good things, people. So how does this repo market work? Well, it's transactions between banks, hedge funds, and financial institutions that trade collateral for cash between banks in a form of treasuries or mortgage-based securities. So George Gammon explained to us that the feds create bank reserves from the air, and they buy treasuries from the bank reserves, and it allows them to lend to the repo market, bringing down interest rates and also down payments down. So what makes repo interest rates take a hike or go up? Well, that would have to be higher demand for cash than supply, making for a supply and demand imbalance. You would need a, quote, counterparty risk. That means where a bank is about to bust, or if there's not enough, quote, pristine collateral supply, which means you don't know who owns the treasury. It could be one institution that's borrowing it from another, and they're like going to the bank and saying, I want a loan, but basically that's not their money. And the bank says, or they tell the bank that I have this money, and I borrowed it from someone, except they won't say they borrowed it from someone. They'll be like, hey, I have this money, but they know in their minds it's not from them, and that they are asking banks for collateral with it. And then the third situation, the third way to get a hike in repo interest rates is low liquidity, a high amount of demand than there is supply. So what makes repo interest rates go down? Well, more supply than demand, for one, but demand for collateral itself. And the banks tell hedge funds, you have treasuries, we want to buy them, but we'll give it to you as if we're giving you this $1 billion, for example, as if you're borrowing it from us. And keep in mind the interest rates for you will be hiked up, because the bank is thinking, I'm going to buy these treasuries from the hedge fund and they are going to go up. Cha-ching, cha-ching. They're going to bank on that. Yeah. Other things in the news, Zero Hedge headline, things are out of control, you guys. There's a shortage of everything and prices are soaring. What happens next? If you go to your grocery store like you did a few weeks ago, you'll notice some shelves were empty. There's now not so much, but we should be expecting to see that more often than not. There's the proof in the pudding right there, right? And rapid inflation is catching up to us as the Institute Supply Management has starting fees to share with us. Quote, they say, things are now out of control. We are seeing wide-scale shortages. Electrical equipment, appliances, components, supply chains are depleted. Inventories are up and down. The supply chains are empty. Prices are rising so rapidly, they say. You hear them say after COVID, they're not able to get the materials to build locally or internationally, overseas. There is, quote, a sense of urgency, you guys, that's felt. Steel prices and wood prices are going off the charts high. That's why it's better, if you want to purchase a house, purchase one that already has a skeleton, a foundation, because you're going to be paying big dollar for the house. Because look at wood and steel. They're just off the charts, like I said. And to confirm this shortage, B of A Chief Investment Officer Michael Hartnett said this: our worldwide supply chain and ability to provide products and services to you is being significantly impacted by increased prices resulting from labor and raw material shortages. Escalating raw material prices, manufacturing delays, and transit interruptions. Stated directly, our costs are increasing and are as much more volatile than in the past. Now, that's not good news, people. Zero Hedge also reported other things on the news that Zero Hedge said that Bloomberg reported that the 10-year yield is back at a high since June at 1.73, while the 30-year Treasury is at almost 2.5%. The dollar remained unchanged this week, but Bitcoin surged or took a spike to above 60,000. That's good, people, right? For those invested or considering investment in it. While Ethereum also spiked and gold went up. But oil prices dove. They plunged this week with a WTI or distressing WTI benchmark that didn't par up. It was at $60. Prices not seen since October. That's all the news I have for you guys. Keep prepping up, preparing, doing whatever it takes to be above the curve. Get your education, learn whatever it is you need to learn. Barter services if you have to. If you got a skill, because We don't know what's coming ahead, people. It's kind of scary, but if you're prepared and you do the heavy lifting, you should be okay. Thank you for watching. Have a blessed weekend, and we'll talk to you real soon. Thanks again for watching and your support. Please do like, subscribe, bring people on board, because we have new information to give you. Yes, we'd like to update you. Thank you so much for watchers. Bye.